So we're going to be working through Objective 6. Again, if you're interested in looking at petty cash and things like that, I encourage you to read the rest of Chapter 7. We're going to skip to Objective 6 where we're looking at the bank reconciliation. You may know this better as balancing your bank statement every month. So when you get your bank statement every month, and this is one of those things that you should use in your personal life, even if you never become an accountant, but you've got your personal record where you've got a list of how much money you have in your checking account, let's say. And then you get the bank statement every month from the bank. And you'll notice there's a discrepancy between what your records show that you have and what your bank statement shows that you have. So a bank reconciliation reconciles those differences or balances the bank statement and your personal books. Because of those timing differences, some things have cleared the bank before other things is typically why that exists. So when we get the bank statement, to the bank statement, we need to add what we call deposits in transit. Deposits in transit or outstanding deposits are things that you have deposited into the bank, but they had not cleared your bank as of bank statement date. So I don't know about you, but when I get a check now, I usually deposit it with my phone. I take a picture with my phone and I deposit it that way. But that takes about 2 to 3 days before the money actually shows up in my bank account. So if bank statement date fell in that 2 to 3 day window there, that would be a deposit in transit. An outstanding check would be a check that I wrote, or it doesn't even have to be a paper check. It could be that I paid a bill online and the money hasn't come out of my bank statement yet, or I swiped my debit card and for some reason there was a delay. But it's when I have spent money out of my account, but it hadn't cleared as of bank statement date. Now, on the book side, we want to add or subtract things that are already in the bank statement but had not been recorded in our books yet. So this could be what your book is calling credit memorandums or direct deposits, things that were deposited directly into your bank statement, in your bank account, but you had not recorded them in your books yet. If you had some electronic payments, again, come directly out of your bank account, but you hadn't taken them out of your books yet. If you get charged a service charge, if you get interest on your checking account, if there's an NSF check or what we call a bounce check or an insufficient funds check. Now, let me be clear. This is not a bad check that we wrote. I'm assuming that all of our company checks are good. This means a customer gave us a check and we deposited it and we recorded it as a deposit in our accounting records. We debited cash thinking that it was a good deposit. And now the banks come back and said, you know what, that check from Peggy Sue is not good. And so now we have to go back and take that money back out of our books because it's clearly not there. And we need to be contacting Peggy Sue and asking her to bring us a money order. So we're given some data here and we're going to walk through an example problem together. We're told that on April 30th, our bank statement showed a balance of 12,720, but our company records, our company cash account showed a balance of 20,850. So I need to balance that out. I need to reconcile that and get them to be the same. So on the bank side, I'm going to start off with the bank statement balance. I want to add the deposit in transit, and I'm going to subtract, so I'm going to put it in parentheses here, subtract the outstanding check. So I had made a deposit of $9,000 that was not reflected in the bank statement, and I had written check 204 for $2,000 that had not cleared the bank as of bank statement date. So that brings the balance, what we call the adjusted bank balance, to 19,720. So if we look on the book side, we're going to be looking for things that were in the bank statement, but I had not recorded in my books. So I had an EFT receipt from a customer, so a direct deposit into my bank account of $100, and I had interest revenue of $30. But I also had some charges that were automatically taken out of my bank account that I had not reflected in my books yet. So I had a service charge of $20, the water bill just came directly out, and then I had a customer that had given me a check for $1,200, and that was a bad check. So that I have to take out of my books as well. So I'm going to subtract that 1260 there for all of the service charge, the water bill, and the NSF check. And then we notice that the adjusted balances now agree, they balance. So just some rule of thumb, you on the bank side, you're always going to add the deposits in transit, subtract the outstanding checks. On the book side, you're going to add any bank collections, interest revenue, or EFT receipts. You're going to subtract any service charges, NSF checks, or EFT payments. EFT stands for electronic funds transfer. Now, the last step is that we have to do journal entries for everything that's on the book side. So, for everything that was in the bank statement but we hadn't recorded in our books, we have to do a journal entry for. So, when we had the EFT receipt from the customer, we debited cash, credited accounts receivable. When we had the $30 of interest revenue, we debited cash, credited interest revenue. When we paid the service charge, the bank service charge, we debited bank expense, credited cash. When we had the water bill that automatically came out of our bank account, we debited utilities expense, credit cash. And then when we had the NSF check from the customer, now I'm going to credit cash, but I'm going to debit accounts receivable because that customer still owes me that money, and I'm going to be sending them a bill telling me, by the way, you owe me that $1,200. And so now that we've posted those T accounts, those journal entries to the T account, notice that the balance in the cash account equals the $19,720, which was the adjusted balance on our bank reconciliation.